SoFi and PayPal reported good earnings report, at least that's what I'm thinking, that's what I said yesterday in both of those videos, but the stock did not agree with me, right? The stock did go down for both companies around 6-7% or so, but as you can see right here, SoFi yesterday did rebound on that 20-day moving average, and actually today it's up 5.7%. It's what I said yesterday. It could be another Robinhood type of scenario. Good report, stock goes down the next day or during that day, and then the next coming days we are actually seeing the market realize that, oh, was a good report, stock shouldn't be down, and so we're seeing a rebound. That's exactly what we're seeing today. Now, as for PayPal, it's a bit of a different story here also. Good report, of course, growth-wise not as good as SoFi, but it's a different type of company or different stage right now. But yesterday, you see, we still had a big green candle. Today, the stock is down 1.82%. So different story, of course. SoFi, much younger, much smaller, triple beat, huge growth. So you can understand why today suddenly the stock is up 5.6% or so. Plus SoFi did have or does still have quite a high short interest, around 15-16% or so. So that's the main difference, just purely looking at the stock, purely looking at those candles here. Now let's dive a little bit deeper. If you enjoy this type of videos, leave it a thumbs up, subscribe if not. We really appreciate that. If you want to support me even further, do check out the links down in the description and in the pinned comment with the top 10 best stocks to buy now, or go to fool.com/couchinvestor. Thank you very much. So let's first start with SoFi right now. It has a market cap of $11.16 billion. In my opinion, looking at the forward PE, 53, 54 times right now, does not make much sense because it's still early in their profitability stage, right? I mean, a year ago, the company was not really profitable. Now, 4 consecutive quarters of profitability. So we're starting to get there. Plus, if you look at what the analysts are expecting, they're expecting EPS to grow much, much faster than the top line. Oh, and by the way, despite the stock's reaction yesterday, which was down 6-7% or so, analysts came out with a higher price target yesterday, which is why you're seeing the average analyst price target being at $9.30. Yes, it is 11.17% lower than the price we're at today. But before the earnings report, the average analyst price target was closer to $8.8. As for PayPal, it's a bit different here. Forward PE for these types of companies, I mean, 16.9 times. And here, yes, looking at forward PE does make a little bit more sense. But I still believe that PayPal is quite undervalued. Because if you look at the average analyst price target, still sits 11.6% higher than the price we're at today. And here as well, we've got some new price targets which have put the average analyst price target higher than it was before the earnings report. Now, I do want to start off with SoFi here in a correction from my part. I said yesterday deposits were $1.4 billion, but I clearly looked at the wrong slide, so it didn't add up to the real number, which was $2.4 billion. So apologies on that. All the rest compared to the predictions are right here on the screen. Now, let's go and look at the things that were mentioned during the earnings call. By the way, if you want to look at the whole review video, that will be in the top right corner. That was for yesterday. Today's video, I do want to focus more on what was mentioned during the call, which was basically all of this and a little bit more. So they've seen the highest average unaided brand awareness ever. That's up 40% year over year to just now 7%, still far, far away from where they want to be. And of course, having the SoFi Stadium helps with that as well. And this is helping them reach their goal of being a top 10 financial institution in the United States. They said this is not an if it will happen, this is a when it will happen. They also saw the highest home refinancing volume since Q2 2022, new partnerships with 2 charter banks in Mexico, and a Galileo for commercial payments. The annualized revenue per product is now $81. That's up 52% year over year. They see significant growth potential in monetization, especially in the invest business. They're focusing on member growth, product growth, and revenue per product. They're also saying that the invest business has over 100% opportunity to increase monetization per member. They say that the small and medium business segment is a key growth area. We've heard that with PayPal as well. With regards to the tech platform and, well, the announcements of maybe a big whale signing with them, etc., an analyst asked about that. They said no decision have been made on large deals with big financial institutions as of right now. They're confident of future wins in the tech platform business. They said large financial institutions are struggling with technology transitions. Now, of course, we've talked about that for a while now. I mean, I'm still expecting an announcement, I would say, in the next 2 quarters. Hopefully, we get an announcement with regards to that side of the business because it's been a while. And I mean, we keep getting that sense of, oh, we are the AWS of fintech. Yes, there are here some small partnerships, 2 charter banks in Mexico and stuff like that. But it would be nice to actually get that huge news, right? Or at least more information with regards to developments around those segments. Let's hope. Next 2 quarters, that's just my prediction. Now, like I said in the last video, I mean, this was an amazing quarter, growth across the board. If you see here, member growth 35% year over year. Products have increased 31% year over year, or 37% if you exclude the digital assets account. Galileo was a bit slower, 17%. But as I said previously, I was expecting a tougher year over year comparison because, well, Q1, Q2 of 2023 were quite weak. So the previous quarters were quite easy to beat on a year over year comparison. Now Q3, Q4, a bit more difficult. So we'll see what happens in Q4, but still 17% year over year growth, quite okay. As for the image, right, that SoFi has, oh, it's just lending. Well, maybe it was, but now as you were seeing here, financial services plus tech platform as a percent of adjusted net revenue is up 4% quarter over quarter to now 49%, and well, growing quite nicely. Now, overall, over the last couple of quarters, couple of years, you can see that this business has done quite well, lending, technology platform, financial services, despite, of course, the troubles that lending have, right? Student loans, refinancing, and all of that. I mean, this quarter for lending, quite a good quarter. Contribution profit from lending reached record highs. Actually, contribution profit for all of the segments reached records. So again, great performance across the board. I was really not worried. You can watch the video from yesterday. Stock went down, was not worried because I knew that this was a very, very good report. And imagine you have triple beat and you're down 6%. What happens when you're missing, right? Imagine SoFi misses, double miss. What, are we going to go up 50% or something like that? It's like the exact opposite because look, quarterly adjusted net revenue up 30% year over year. EBITDA up year over year, quarter over quarter by quite a lot, and now an EBITDA margin of 27%. Guidance has also been raised. You can see this on the screen or if you watched yesterday's video. Now, let's go over a couple of comments that were made during the earnings call. So there was a question about, well, growing their balance sheet and stuff like that, maybe some worries around that, but Anthony Noto made it quite clear that that's not the plan and they're not worried about that at all. He says here we're making incredible progress in our shift towards more fee-based, capital light and lower risk revenue sources. Combined fee-based revenue made up $174 million or a quarter of our adjusted net revenue in Q3. This revenue grew by 65% year on year. On an annualized basis, that's nearly $700 million in revenue. This progress was driven by a record quarter in our loan platform business, which totaled $56 million in fee-based revenue and is up more than 5x year over year, as well as growth in interchange, which is up 2x year over year. So, yeah, I mean, this is great. Better margins, more profitable as well, less risk. So it's exactly what you want to see. Then with regards to that balance sheet question, so he said here, what I would say is our overall outlook for originations or at least growth on the balance sheet has not changed. We do expect to see modest growth in dollar terms on the balance sheet year over year, and that will continue into Q4. We are happy with the size of the balance sheet that we have today and the amount of net interest income that we're generating. So, okay, that's already one answer. Now, with regards to going into a lower rate environment, they said the following: where we will migrate into is in a lower rate environment. You would see an uptick in demand for our student loan refinancing business, where we had a really strong quarter this quarter, as well as our home loan business, where we had our best quarter since 2021. They also reiterated that they're still on track to reach those 3-year goals that they mentioned last year. What were those goals? Well, it's basically this. For the 2023 through 2026 time period, we see 20 to 25% compound annual revenue growth, assuming no meaningful change in the macro environment, no significant new business launches or acquisitions, etc., etc. The 20 to 25% compound annual revenue growth from 23 to 2026 assumes a compound analytic growth rate of 50% for financial services revenue, mid-20s for the tech platform, and mid-teens for the lending segment revenue. They also see 20 to 25% EPS growth beyond 2026. They're still on track for that. On the profitability front, bridging down to GAAP EPS, we expect to generate 30% EBITDA margins by 2026 and 20% GAAP net income margin by 2026, and stock-based compensation is expected to be a high single digits as a percentage of revenue. So if you put all of those CAGRs and the profitability targets into place, and that gets you to your 55 to 80 cents of GAAP EPS. And as I said previously, as long as those targets do not change, or at least not on the downside, I really don't see why we should doubt management. Moving on to PayPal here, the miss was a small revenue miss, and then with regards to guidance, they reiterated the GAAP EPS estimates, but that missed by 3 cents. Overall, again, good quarter, a perfect one, no, but a pretty good one. So, I mean, not much to complain. They've got a lot of cash, generating billions in free cash flow, buying back billions of dollars worth of shares. So, I mean, as long as the stock remains low, they can buy more and more shares. That will definitely benefit future shareholders. Now, I don't want to say that revenue has grown just 6%, and maybe that's the issue, right? That revenue is not growing as fast as expected. 6% is probably the lowest revenue growth that we're seeing for PayPal until now, since they became public. So yes, maybe that's something to watch out for, but all the rest were quite good, as I explained yesterday. Active accounts are up year over year for the first time since Q1 2023. Transaction per active account is also up quarter over quarter and year over year. So that's great. If we look at transaction margin dollars, that has increased quarter over quarter, and it's also up 8% year over year. As for transaction margin, we're now at 46.6%. That's up 115 basis points year over year. So all good on that front. But total take rate and transaction take rate continues to go down. Hopefully we're reaching the bottom pretty soon. Overall, for the quarter, TPV mix across PayPal's payment platform. This is basically the picture. If you want to look at all of that, pause the screen or just go watch the other video. I want to switch really quick to what was mentioned during the earnings call. So Venmo debit card. This card allows users to spend their Venmo balance both online and offline. It generates revenue through the interchange fees and interest income. Still early days with regards to Venmo's monetization. They also have Pay with Venmo. This feature allows users to pay with their Venmo balance at online merchants. It generates revenue through transaction fees. Their goal is obviously to monetize the Venmo arm of the business very, very early on from both sides, by the way. Alex Chris also highlighted that PayPal is now offering an ads platform to its merchants, allowing them to target the right customers at the right time with payments APIs. This was mentioned as a key component of PayPal's price to value strategy for Braintree, where they aim to provide more value to merchants beyond just payment processing. So now that they are switching towards a price to value strategy, of course, margin-wise, profitability-wise, this is better, but growth-wise, this might and will impact them a little bit for now. They said that Fastlane is gaining traction with over 1,000 merchants. Large enterprises are showing interest in Fastlane, but implementation may take time. PayPal is working to convert Fastlane users into branded checkout customers. Improved Braintree margins and a shift towards large enterprise customers are impacting the take rate. The company is focused on improving branded checkouts performance and gaining market share. Last one here, there is potential for branded checkout growth to accelerate, driven by innovation and increased customer engagement. As Alex Chris has said from day one, this is all about profitable growth. So yes, we might not see huge revenue growth for the overall business, but we're definitely seeing profitable growth. And maybe once they are comfortable, maybe then they'll accelerate a little bit and turn the growth engine on. Now, as for the fourth quarter, we've got here some comments. So they said that they expect revenue to grow by low single-digit percentage. This is directly related to Braintree merchants negotiations and ongoing efforts to drive quality, profitable growth. As I mentioned earlier, this is a deliberate action and a continuation of the strategy we articulated throughout the year, where we have accepted a lower near-term Braintree revenue profile in exchange for better margins as we have renegotiated agreements. As a result of these efforts, we expect lower Braintree volume and revenue growth in the fourth quarter and through 2025 before reaccelerating from the reset baseline. So here basically already giving us some 2025 guidance. Now, this does not mean that 2025 will be a horrible year. No, I still think that 2025 could be a very, very good year. Plus, if they keep on generating at least $6 billion in free cash flow and buying back at least $6 billion worth of their own shares, then they start to reaccelerate growth. I mean, that's a pretty strong position to be in. And so this is basically the picture for Q4 and for full year 2024. Transaction margin dollar has been revised a little bit on the upside, GAAP EPS as well, and so did non-GAAP EPS. So overall, that's about it. I'm still extremely bullish on both of those companies. SoFi, as you see right now, is having a little rebound, a nice rebound the day after, not surprised. And PayPal, well, still PayPal, still a very, very good business. I still think that the stock should be above $100, but I don't control the market. So all in all, still very bullish on both companies. That's all I've got for you in this video. Do share your thoughts down in the comment section below. Like, subscribe to all of that, and I'll see you all in the next one. Bye-bye.